At hiring an investment advisor, I'm going to show you why it's preferential to pay a commission and not a fee. At least a fee that you pay on an annual basis, like the typical 1% that has taken over the financial advice industry, or at least the investment advice industry. I know this is crazy, right? Commissions, they're evil. Everyone tells you how evil commissions are. We see all these advisors out there saying, I'm a fee-only advisor. Oh, okay, that might be fine. It might not be, but you need to know both of your options. And we're going to share that with you here today at the Heritage Wealth Planning YouTube channel. So thanks for coming on board. If you like what you see here, subscribe down below, my friend. Subscribe and then hit the little bell to be notified for future content, because we're doing like 2 or 3 videos a day now. So you want to keep notified, because lots going on. All right, so let's dive right into this. One of my pet peeves, frankly, has been in the world that has, for some reasons, has taken over the terminology that commissions are inherently bad, and I've never understood that. I frankly understand it even less today, given what I've seen about the fee that some of these investment advisors charge. So the issue is, you pay a commission, that's bad because they're going to churn and burn you, and they're going to sell you this and sell you that. And that is bad. I mean, no getting around it. If I sell you something here and 3 months later I sell you something over there, I mean, ideally you'll have compliance. They'll say, hey, you can't churn this person's account. I get that it misses a lot. But at the end of the day, a commission, like a firearm, like anything else, is not good or bad like an annuity. It just is. If people are using it incorrectly, those people should be held accountable. But the commission itself is neither good nor bad. It just is. Now, if you're looking for advice, though, and I'm going to show you why a commission is going to be preferable, in my opinion, than paying that 1% annual fee. Now, the opposite of the fee guys always, or ladies always say, well, I'm fee based. Now, I just want to clarify what fee based is. That means they're typically going to be fees on their investments, but there'll be commissions on their insurance. So they can't say they're fee only, because they're not fee only. They get commissions on insurance products or some other product, might even be investment, but they base their model on fees, on annual fees, the 1% fee as we're talking about. And that's fee based. Those people who sell something for a commission inherently cannot say they're fee only. Fee only is neither good nor bad. Neither is a commission. Fee only says, I do not get paid commissions to sell you something. I get paid fees on the advice I provide to you. And that advice could be, a 1% annual fee of the assets that you hold with that financial advisor. I shouldn't even say that, investment advisor. Now, there might be other services that you receive, but that's now the model that has basically dominated the investment advisory industry. The days of the commission are being pushed out, because so many people think the commission world is somehow bad and the fee world is somehow good. And I frankly don't. Again, it's neither good nor bad, but I'm going to show you why fees are not necessarily the way to go. In fact, my preference would be to pay commissions. I'm going to show you why. All right, so this is American Funds, AmericanFunds.com, and I'm a huge fan of American Funds. That does not mean you should buy an American fund. Do not buy an American fund. Off this, do not take this as a recommendation to buy an American fund. Do not buy a mutual fund, a Vanguard, otherwise, off of what you see here. I cannot be any more clear or explicit. I am not recommending you anything. I'm just going to show you the real world, and you got to take it for your own. I do not sell mutual funds. I don't get paid on investing. So this is on you, not on me. I just got to be clear there that I'm not recommending this. The reason I'm using the Income Fund of America is because it's been around for a long time. It's got a good track record. They charge a front end A share commission, which means you pay a front end fee. And on top of that, there's a fee in there as well called a 25 basis point trail. So 12B1 fee. I don't even know if they offer those anymore. But generally speaking, that's the way it was in the old days. You get paid a front end commission, old Josh, 5.5 to 4.5 to 3.5, depending on how much money you put in. And each and every year to essentially service your account, I get a trail of 25 basis points, or 1/4 of 1%. Those days, again, are kind of going away now, unfortunately. A lot of the American funds, in fact, I don't even think you could own an American fund unless you bought it through a salesman, like a Ed Jones guy or a Merrill Lynch guy or something like that. I don't think you could. Now, the drawback about buying a commission is, I tell you, some of these guys will say, times are tough. Maybe I can get that person out of that American fund I put them in and go buy this Oppenheimer fund. And that would be essentially, I'm going to sell you a new fund with a new sales charge. and we're gonna sell the one that we bought before with a sales charge. In that case, you're paying two sales charges. That's not good. That is churning. No other way around that. And anyone who did that on the Income Fund of America should be held out, because that's bad news. That's bad. There's no reason to sell a mutual fund that you've already paid a commission on, and to buy another one because it's better somehow. That's just silly. Now, if that happens, I get it, but that should be policed up by the brokerage, that Jones or Smith Barney, whatever. They should police that up, and they do a pretty good job of that. I know that for a fact, because I worked at Smith Barney, and you could not do that. I'm sure there was some guy did it, but the vast majority of people didn't. All right, so that's an Income Fund of America. It has a moderately low fee on an annual basis. The expense is what it's called. Is roughly, I think, 50 basis points or something, 1.5%. And you throw in the 25 12B1 fee. So you're paying all in about 75 bips, 0.75%, maybe even a little bit less after you pay the front end commission. So I'm going to use that for my example because we have a track record of a long time. It's a moderately, just plain vanilla fund. It's about 60 to 65% blue chip U.S. stocks, 35% or so in, I guess, corporate and government bonds. Nothing fancy about this fund at all. You literally could not get any more plain vanilla than the IFA Income Fund of America. And then I'm going to compare it to the S&P 500 without any fees, without any commissions. And I'm going to compare it to the Russell 2000 without any fees, without any commissions. The Russell 2000 small cap U.S. stocks, more aggressive and probably will outperform. I would not be shocked if that were the case. More aggressive, more risk, more performance, typically. S&P 500 is the blue chips of the U.S. economy. All the big guys you know of, GE included. I don't even know GE's still in it because they got hammered, but those kind of stocks, the big blue chips that you're familiar with. All right, so we're going to go back to 20 years just because you have a couple years to ramp up right before the markets crash, and we're going to say at the end of 2018, what did we do? We're going to charge a 3.5% on the front end here for the American funds, and these have no fees and no sales charges whatsoever. Let's just take a look. So we're going to see what the difference was between the three funds. And I've already ran this, so I already know, but I'll figure I'll show you the visual so you can see it for yourself because it's interesting, actually. All right, so what we see is the American funds is in blue, the Russell 2000 is in green, and the S&P Russell 2000 smoked both of them. But the Income Fund of America, I wouldn't say smoked the S&P, but the Income Fund of America was at 385,000 roughly. S&P 500 was at 367,000 roughly. So roughly 20,000 more in the Income Fund of America than the S&P 500, even though you paid 3,500 right out of the gate and an annual expense ratio too of roughly 50 to 75 basis points, or 0.5% to 0.75%. And now the Russell 2000 has smoked both of them, and that's because, generally speaking, the more aggressive you get, the longer term you hold it, the more money you will make. But again, it didn't happen until right about here. That's 2013, and that's when we started seeing the small caps really take off. And, I mean, just look at the difference between that and that. I mean, if that anything tells you, that means the prices on small caps are high. And again, not saying sell it, don't know. I'm just saying that's the first thing that jumps out at me. Everything was even Steven until right about 2013. And then the small caps are dominated, which tells me that there is some more upside potential for the larger companies for sure. All right, so that's what I want to show you. Now, that's with commission, again, competing against the S&P 500 with the headwind in bonds that the Income Fund of America had, with the fact it had a 3.5% commission on the front end, and with the fact that it had an annual fee of roughly 50 to 75 basis points. It still beat the S&P 500 when all is said and done. That doesn't shock me in the least. In fact, it looks like it beat it every single year except for the front end right here, which is where you pay that commission. And it kept neck and neck with the small cap right up until 2013 as well. So I'm not shocked by that in the least. It just is. And people can argue that all day long. And you can run any numbers. I frankly don't care. I mean, this is what I'm going to show you. So now I'm going to take you to something else. So let's go over here. And this is a website called firecalc.com. Firecalc.com. Wonderful, wonderful website. I've been using it for a long time. I actually try to give them money to donate because I love the website, but at least this couple of years ago, it didn't allow me to actually send them money. It was weird. I wish they would because I'm a big fan. And what we're going to do here is I'm going to show you how much we're going to pay 18 basis points. That's their default. So we're having a bunch of index funds that cost 0.18% a year. It's actually even cheaper than that now. And we're going to do it just a broad-based portfolio similar to the Income Fund of America, or it's similar to the Russell 2000 and S&P 500, all kind of just a combination of a fund that has small cap stocks, large cap stocks, long-term government bonds, and long-term corporate bonds. So we're going to have 20% small, 40% large S&P domestic stuff. We're going to have 20% government bonds and 20% in corporate bonds, all long-term. And we're only going to charge 0.18%. That's the operating expense, what's called expense ratio of the funds, the index funds that we're going to use. And we're going to go back 20 years. So let's see here. What is our time frame? Can we do this over 20 years? Let me pause for a second to figure out how we do that. Now, right here. There we go. 2000. We're going to go to 1998. All right, cool. And let's see what we get. So after we run these numbers, we're going to have a portfolio since 1998. I'm writing this down. On the average was 1.19. How much did I start with? I got to put $100,000 in there. How much did I start with? We start with 300,000. Let me go back here, and we want to start with $100,000. Crack cow. All right. Boink. Let me pause it real quick, my friends.